There are moments in history when the air itself seems to change, when the comfortable certainties of everyday economic life begin to show hairline fractures that most people dismiss as mere coincidence, but which those of us who have studied the great collapses of nations and empires recognize as something far more troubling. I have spent the better part of 40 years studying the rise and fall of economic systems, from the currency debasements that toppled Rome to the speculative manias that preceded the Great Depression. And I can tell you, with the weight of that experience behind me, that what we are witnessing in America today is not normal market volatility, but rather the convergence of warning signals that have preceded every major financial disruption in modern history. The patterns are there, carved into the statistical record like ancient runes, and they speak of a countdown that began some time ago and points toward a reckoning that may arrive as early as 2026. This is not prophecy or fear-mongering, but pattern recognition, the same kind of analysis that allowed a small number of observers to see the 2008 crisis approaching years before Lehman Brothers collapsed, or to predict the dot-com implosion before the Nasdaq lost nearly 80% of its value between 2000 and 2002. I ask you now to stay with me through this entire examination, to resist the temptation to dismiss what follows as alarmist speculation, because understanding the full depth of what is unfolding requires patience and a willingness to see how disparate economic forces interlock like gears in a machine that is beginning to grind rather than hum. Comment below and tell me where you are watching from, what city and country, because this is a global conversation about American economic stability, and the reverberations of what happens in the United States financial system will touch every corner of the world, just as they did in 1929 and again in 2008. The yield curve, that arcane measure of Treasury bond interest rates that most Americans have never heard of, inverted in July of 2022 and remained inverted for over 2 years, the longest such inversion in recorded financial history. To understand why this matters, you must first grasp what the yield curve represents. It is essentially a snapshot of investor confidence in the American economy's future, expressed through the interest rates on government bonds of varying maturities. In a healthy economy, longer-term bonds pay higher interest rates than shorter-term bonds because investors demand compensation for the risk of locking their money away for extended periods, creating an upward-sloping curve when you plot these rates on a graph. When that curve inverts, when short-term rates rise above long-term rates, it signals that bond investors believe current economic conditions are riskier than future conditions, which is another way of saying they expect the Federal Reserve to cut interest rates in response to a coming recession. The yield curve has inverted before every single recession since 1960, with only one false positive in the mid-1960s, giving it an accuracy rate that would be the envy of any economic forecaster. The Cleveland Federal Reserve, in its analysis published in October of 2025, reaffirmed that the rule of thumb remains intact. An inverted yield curve indicates a recession in approximately 1 year, though the lag time has historically ranged from 6 months to 2 years. What made the recent inversion so remarkable was not just its duration, but its depth and the context in which it occurred. The Federal Reserve, under Chairman Jerome Powell, raised interest rates at the fastest pace since Paul Volcker's legendary inflation fight of the early 1980s, when the federal funds rate was pushed to 20% in June of 1981, triggering a brutal recession that sent unemployment above 10%, but ultimately broke the back of inflation that had peaked at 14.8% in March of 1980. Volcker's approach was economically painful, but historically necessary, a bitter medicine that restored credibility to American monetary policy and ushered in the Great Moderation of the subsequent decades. The difference between Volcker's era and our present moment lies in the structural vulnerabilities that have accumulated in the financial system during the long period of ultra-low interest rates that followed the 2008 crisis. Vulnerabilities that make the current rate hiking cycle far more dangerous than what Volcker faced, despite the slower pace of increases. Consider what happened in March of 2023 when Silicon Valley Bank, the 16th largest bank in the United States, collapsed in the span of 48 hours after a bank run that saw depositors withdraw $42 billion in a single day. This was not a traditional bank failure driven by bad loans or fraud, but rather a duration mismatch problem, where the bank had invested customer deposits in long-term treasury bonds and mortgage-backed securities that plummeted in value as interest rates rose, creating what the Federal Deposit Insurance Corporation reported as $516.5 billion in total unrealized losses across the banking system as of the first quarter of 2024. Silicon Valley Bank's collapse was followed within days by the failure of Signature Bank, and then in early May by First Republic Bank, which, despite receiving a $30 billion lifeline from 11 major banks in mid-March, could not stem the tide of deposit outflows that exceeded $100 billion in the first quarter alone. J.P. Morgan Chase ultimately acquired First Republic's assets after regulators placed the bank into receivership, but the damage to confidence in regional banking had been done. The parallels to the savings and loan crisis of the 1980s and early 1990s are instructive here. That crisis, which ultimately cost American taxpayers over $120 billion in today's terms, was also triggered by a duration mismatch when S&Ls found themselves paying high interest rates on deposits while holding long-term mortgages issued at much lower rates, squeezing their net interest margins until hundreds of institutions became insolvent. The difference today is the speed at which bank runs can occur in the age of digital banking, where a depositor can move millions of dollars with a few taps on a smartphone rather than waiting in line at a teller window as depositors did during the bank panics of the Great Depression. The FDIC, which insures deposits up to $250,000 per account, found itself facing a crisis of confidence that required extraordinary measures, including the controversial decision to backstop all deposits at Silicon Valley Bank and Signature Bank regardless of the insurance limit, a systemic risk determination that carried an estimated cost of $19.2 billion that will be recovered through special assessments on the banking industry. This intervention prevented a broader panic, but also set a precedent that raises questions about moral hazard and the true capacity of federal backstops to contain a crisis if multiple large banks were to fail simultaneously. The unrealized losses sitting on bank balance sheets, which increased by $39 billion between the fourth quarter of 2023 and the first quarter of 2024, according to FDIC data, represent a latent vulnerability that becomes acute whenever banks need to sell securities to meet deposit withdrawals or regulatory capital requirements. Regional banks, which hold substantial exposure to commercial real estate loans, face particular pressure as the office market vacancy rate has climbed to 20.7% nationally as of the second quarter of 2025, according to Moody's Analytics, with San Francisco reaching 27.7% and major business districts like downtown Manhattan approaching 23% vacancy. This is where the second major signal intersects with the first. The banking system's fragility is amplified by its exposure to a commercial real estate market that is undergoing not a cyclical downturn, but a structural transformation driven by the permanent shift toward remote and hybrid work arrangements that has persisted long after the pandemic's end. Approximately $290 billion in loans tied to office properties are scheduled to mature by the end of 2027, creating what industry analysts call a debt wall, where borrowers will need to refinance at substantially higher interest rates while their properties have declined in value, making traditional refinancing difficult or impossible and forcing either debt restructuring,
property handbacks to lenders or outright defaults. The historical precedent for this kind of commercial real estate distress can be found in the early 1990s, when overbuilding and an economic recession combined to produce widespread defaults on commercial mortgages, particularly in markets that had experienced the most aggressive development during the 1980s boom. That crisis contributed to the failure of over 1,000 banks and savings institutions between 1986 and 1995, though it unfolded over a longer time frame than the acute phase we may be entering now. The velocity of change in today's office market, where tenant demand has fundamentally shifted in a matter of years rather than decades, suggests that the repricing of commercial real estate values may occur more abruptly than in previous cycles, with corresponding stress on the financial institutions that have underwritten these properties.
The Joint Center for Housing Studies at Harvard University, in their 2025 State of the Nation's Housing Report, documented that the typical existing single-family home reached a record high of $412,000 in 2024, representing 5 times the median household income, a ratio that senior research associate Daniel McHugh described as shocking and significantly above the traditional affordability threshold of 3 times income that prevailed for most of the post-war period. Only 3 of the nation's 100 largest metropolitan areas, Akron in Ohio, McAllen in Texas, and Toledo in Ohio, maintained price-to-income ratios below 3, while cities like Los Angeles and Miami saw ratios of 8 or higher, meaning a median home cost 8 times what the typical local household earned annually. This affordability crisis has been driven not by the predatory lending and speculative excess that characterized the mid-2000s bubble, but rather by a structural supply shortage combined with mortgage rates that surged from approximately 3% in late 2021 to over 7% by late 2023, the fastest increase in mortgage costs since Paul Volcker's Federal Reserve pushed rates to record levels in the early 1980s. To afford the typical mortgage payment of $2,570 per month on today's median-priced home, a buyer would need to earn at least $126,700 annually. Yet, as of 2023, only 6 million of the nation's 46 million renter households met that income threshold, according to American Community Survey data. The National Association of Home Builders calculated that 74.9% of United States households cannot afford a median-price new home in 2025, with 23 states and the District of Columbia seeing more than 80% of households priced out of the market entirely. This represents a fundamental disconnect between the asset that has historically served as the cornerstone of American middle-class wealth accumulation and the earning capacity of American workers, a gap that since 2000 has seen median home prices increase 177% while median household income grew only 92%. And when adjusted for inflation, the disparity becomes even more stark, with real incomes up only 8.5%, while real home prices climbed 56%. The consequences of this affordability collapse are already manifesting in ways that will reverberate through the broader economy. The United States home ownership rate fell in 2024 for the first time in 8 years to 65.6% and continued declining to 65.1% in early 2025, reversing decades of policy efforts to expand home ownership and threatening the wealth accumulation patterns that have defined American economic mobility since the post-war suburban expansion. The historical parallel worth examining here is not 2006 through 2008, when falling home prices triggered a foreclosure crisis and banking collapse, but rather the housing affordability squeeze of the late 1970s and early 80s, when high inflation combined with high interest rates effectively froze the housing market and locked millions of Americans out of home ownership for years. The difference today is that we enter this period with housing already unaffordable at a structural level even before interest rates rose, meaning that even if the Federal Reserve successfully brings rates down, there is no guarantee that housing will become accessible to the vast majority of Americans without a significant price correction that would wipe out trillions of dollars in household wealth and potentially trigger the banking stress that I described earlier, given the concentration of real estate loans on financial institution balance sheets.
If you have found this analysis valuable, please take a moment to like this video, subscribe to the channel, and activate the notification bell so you can stay informed as these economic signals continue to develop. Comment below and let me know where you are watching from, what city and country, because understanding how these American economic dynamics are being perceived around the world helps us grasp the global implications of what may unfold in the coming months. The commercial real estate crisis that I touched upon earlier deserves fuller examination because it represents a structural shift rather than a cyclical downturn, driven by the permanent transformation in how Americans work following the pandemic's acceleration of remote and hybrid arrangements. Office vacancy rates nationally reached 20.7% in the second quarter of 2025, according to Moody's Analytics, with major business districts like San Francisco at 27.7% and downtown Manhattan approaching 23%, levels not seen since the depths of previous recessions, but now occurring during what has been classified as an economic expansion. The approximately $290 billion in loans tied to office properties scheduled to mature by the end of 2027 creates what analysts term a maturity wall, where borrowers must refinance at interest rates that are 3 to 5 percentage points higher than their original loans, while their properties have declined in value by 20 to 40%, depending on location and quality, making conventional refinancing impossible for many borrowers. The historical precedent from the early 1990s commercial real estate crisis, which contributed to over 1,000 bank and savings institution failures between 1986 and 1995, unfolded over nearly a decade. But the velocity of change in today's office market suggests the repricing may occur far more abruptly, with correspondingly sharper stress on lenders. Beyond the domestic vulnerabilities in real estate and banking, the external shocks that could trigger or accelerate a crisis have multiplied in ways that would have seemed improbable just a few years ago. The economic decoupling in the United States and China, which began as a trade dispute in 2018, has accelerated into what Reuters analysis in April 2025 described as crossing a Rubicon, with tariff rates on most Chinese products reaching at least 145% and threatening to collapse much of the bilateral trade relationship worth $582 billion in 2024. China's share of United States imports declined 8 percentage points from 2017 to 2024, falling to only a third of American imports from Asia compared to half in 2018, as corporations and policymakers alike have recognized the national security implications of supply chain concentration in a geopolitical rival. This decoupling carries profound economic costs as companies are forced to rebuild supply chains that took decades to optimize, costs that are ultimately borne by American consumers and businesses through higher prices and reduced efficiency. The Taiwan semiconductor situation represents perhaps the single most concentrated economic vulnerability in the entire global system, with Taiwan Semiconductor Manufacturing Company producing approximately 70% of the world's advanced chips and the United States importing 70% of TSMC's production, valued at $13.1 billion in the third quarter of 2022 alone, creating an estimated $500 billion exposure if cross-strait tensions were to escalate into conflict or blockade. The BRICS nations, representing Brazil, Russia, India, China, and South Africa, along with recently added members, collectively account for over 40% of the world's population and have accelerated efforts to reduce dependence on the United States dollar in international trade and reserve holdings, what scholars term de-dollarization. Russia's deputy chairman of the State Duma announced in April 2023 that BRICS nations are developing a common currency for cross-border trade, a move driven by what these nations perceive as weaponization of dollar dominance through sanctions and the exclusion of Russia from the SWIFT financial messaging system following its invasion of Ukraine in 2022. While full de-dollarization faces significant practical obstacles, including coordination challenges and currency stability concerns, even incremental shifts away from dollar-denominated trade and reserves threaten to erode what economists call the exorbitant privilege that has allowed the United States to run persistent trade and budget deficits while maintaining currency strength. The dollar's role as the global reserve currency has functioned as a form of hidden subsidy to the American economy, keeping interest rates lower than they would otherwise be and allowing the federal government to finance its operations at favorable terms, a privilege that is not guaranteed to persist indefinitely if alternative payment systems and reserve currencies gain traction among major economies. This brings us to perhaps the most troubling structural vulnerability that differentiates the current moment from previous crisis periods. The federal debt-to-GDP ratio stands at 124% as of December 2024, according to Trading Economics data, a level exceeded only briefly during the pandemic peak of 126.3% in 2020, and approaching the World War II peak that preceded decades of post-war growth and inflation that reduced the debt burden relative to the economy. The difference between our current debt levels and those of the 1940s is that the World War II debt was incurred during an existential military conflict with total economic mobilization and was followed by unprecedented economic expansion and a young population entering peak earning years, whereas today's debt has accumulated during what was supposed to be peacetime prosperity and coincides with the retirement of the baby boom generation that will place enormous stress on Social Security and Medicare over the next 2 decades. The Congressional Budget Office projected in February 2024 that federal debt held by the public would rise from 99% of GDP in 2024 to 116% in 2034, and if current policies remain unchanged, would reach 172% of GDP by 2054, levels that would make the United States debt burden comparable to Japan's, but without Japan's unique economic characteristics, including a captive domestic creditor base and decades of deflationary psychology that have kept interest rates near zero. The implications of high debt levels during a potential economic downturn are profound because they constrain the government's ability to respond with